Listen carefully. If you hold silver today, you need to understand that the conversation taking place beneath the surface of the global economy is very different from the one most people hear in the headlines. The headlines focus on daily market movements. They focus on interest rate decisions, employment reports, inflation releases, and quarterly earnings. Those events matter, but they are not the primary story. The primary story is much larger. What matters is the growing tension between an economic system built on ever-expanding debt and a monetary system that increasingly depends on the creation of additional liquidity to keep that debt manageable. I am not talking about a minor correction. I am not talking about a temporary surge in commodity prices. And I am certainly not talking about speculation driven by social media excitement. I am talking about a structural shift that has been developing for years. Most people are completely blind to what is forming because major financial changes rarely announce themselves in advance. They emerge gradually. They build pressure beneath the surface. Then one day, what seemed impossible suddenly becomes obvious to everyone. By that point, the largest moves have often already begun. When I study long-term economic history, I repeatedly see the same pattern. Nations become successful, credit expands, asset values rise, confidence increases, then success creates excess, debt grows faster than productive output, financial obligations multiply, governments promise more than future revenues can comfortably support. Investors become conditioned to believe that central banks can solve every problem. For a period of time, that belief appears justified. Whenever instability emerges, policymakers respond, markets weaken, liquidity arrives, growth slows, stimulus follows, the system survives. But every intervention carries consequences. Every cycle leaves behind more debt. Every rescue creates larger obligations. Every attempt to postpone adjustment increases future vulnerability. That is why the real question investors should ask today is not whether challenges exist. The real question is whether the current system can continue operating indefinitely without significant monetary consequences. History suggests that heavily indebted systems eventually face difficult choices. They can tolerate economic contraction. They can accept widespread defaults. They can implement painful fiscal reforms. Or they can reduce the real burden of debt through inflation and currency depreciation. History has proven this again and again. The politically difficult options are usually delayed. The politically easier options become increasingly attractive. This never ends quietly. It rarely happens all at once. Instead, purchasing power erodes gradually. Savings buy less. Living costs rise, outseat prices inflate, and many people fail to recognize what is happening until the effects become impossible to ignore. That environment is important because it changes how investors think about wealth preservation. During periods of monetary stability, investors often prioritize growth. During periods of monetary uncertainty, investors begin prioritizing protection. That distinction matters, because the assets that perform well during one regime are not always the assets that perform well during another. For years, many investors have become accustomed to a world dominated by financial assets. Stocks attracted capital. Bonds attracted capital. Technology companies attracted capital. Liquidity flowed toward growth, but monetary regimes are not permanent. Economic environments evolve. The assumptions that work during one decade can become dangerous during the next. You need to understand what is happening. Around the world, debt burdens remain historically elevated. Fiscal deficits continue expanding. Governments face rising obligations related to infrastructure, healthcare, defense spending, and demographic pressures. At the same time, many economies are attempting enormous technological transformations. Artificial intelligence requires infrastructure. Data centers require electricity. Electrification requires investment. Industrial modernization requires capital. Energy transitions require resources. All of these developments demand financing. And financing ultimately means more debt, more liquidity, or both. That reality creates pressure throughout the financial system. The consequences are not always immediate. In fact, the early stages often appear manageable. Markets remain functional. Growth continues. Consumers keep spending. But structural pressures do not disappear simply because markets remain calm. They accumulate. Eventually, investors begin questioning whether future currency purchasing power will remain as stable as the past. That is the moment when capital starts looking for alternatives, not because panic has arrived, not because collapse is imminent, but because intelligent investors understand risk before the crowd recognizes it. That transition is where silver enters the conversation. Most people misunderstand silver. They view it as a simple commodity. They view it as an industrial input. They view it as a volatile trading vehicle, but silver occupies a unique position within the global economy. It exists at the intersection of industry, technology, scarcity, and monetary history. And when those forces begin reinforcing one another, the outcome can become extremely significant. The reason silver continues attracting attention from long-term macro investors is not because of short-term price forecasts. It is because silver sits directly in the path of multiple powerful trends that are developing simultaneously. The majority of market participants are still focused on current conditions, but major opportunities rarely emerge from current conditions. They emerge from future conditions. And right now, the future conditions that matter most are beginning to take shape. The real question is not whether change is coming. The real question is whether investors recognize the signals early enough to position themselves before the broader market fully understands what those signals mean, because once awareness spreads, repricing can happen much faster than most people expect. And that possibility is exactly why silver holders should be paying very close attention right now. Now let us go deeper into the silver story itself, because understanding the broader financial environment is only the first step. The second step is understanding why silver occupies a position that very few assets can replicate. Most assets depend primarily on one source of demand. A company depends on earnings, a bond depends on repayment, real estate depends on economic activity and financing conditions. Silver is different. Silver draws value from multiple forces at the same time. That is what makes it so important during periods of transition. First, there is the industrial dimension. Modern civilization depends on conductivity. It depends on efficient energy transfer. It depends on increasingly sophisticated electronic systems. As technology advances, the need for reliable conductive materials becomes more important, not less important. Silver possesses characteristics that make it extraordinarily useful in advanced applications. It is found in electronics. It is found in energy infrastructure. It is found in communication systems. It is found in medical technologies. It is found throughout the modern industrial economy. What matters is not a single product. What matters is the direction of global development. Look around. Nations are competing for technological leadership. Industries are being modernized. Power grids are being upgraded. Digital infrastructure continues expanding. Artificial intelligence requires enormous computational resources. Data processing requires energy. Energy systems require hardware. Hardware requires materials. And silver remains embedded in many of those systems. This is not a temporary trend. This is a long-term transformation. The world is becoming more electrified, more connected, and more dependent on advanced technology. As that process continues, demand for critical materials can increase in ways that many investors underestimate. But demand is only one side of the equation. The other side is supply, and supply is where the story becomes especially interesting. Many people assume that if prices rise significantly, producers can simply flood the market with new supply. In reality, things are rarely that simple. Mining projects require time. Permits require time. Bochgrapher requires time. Capital investment requires time. Even when incentives improve, production cannot always respond immediately. That creates a lag between rising demand and increasing supply. When those lags appear during periods of strong demand growth, markets can tighten, and when markets tighten, prices become the mechanism that restores balance. That principle applies across commodity markets. But silver has another characteristic that deserves attention. A significant portion of global production is connected to the extraction of other metals. This means silver output is not always driven exclusively by silver economics. Production decisions may depend on broader mining conditions rather than silver demand alone. As a result, supply responses can be slower than many market participants expect. Now combine that industrial reality with something equally important. The monetary dimension. For thousands of years, societies placed trust in precious metals. Empires rose and fell, currencies changed, governments disappeared, financial systems evolved. Yet precious metals repeatedly retained monetary relevance. That historical legacy matters because human behavior matters. Financial markets are ultimately collections of human decisions, and people tend to react to uncertainty in recognizable ways. When confidence is high, investors embrace risk. When confidence weakens, investors seek protection. When purchasing power becomes uncertain, attention shifts toward assets perceived as scarce and durable. Silver benefits from that perception. Unlike paper currency, silver cannot be created through policy announcements. Unlike digital balances, its supply is constrained by physical reality. That distinction becomes increasingly important when investors begin questioning long-term monetary stability. Notice something critical: the industrial buyer and the monetary buyer are not motivated by the same objective. An industrial manufacturer may need silver because production requires it. An investor may want silver because wealth preservation requires it. Two different groups, two different motivations, one shared asset. That is where conditions can become interesting. If industrial demand strengthens while monetary demand also strengthens, pressure begins building from multiple directions simultaneously. The market no longer depends on a single catalyst. It depends on several reinforcing catalysts. History shows that powerful market moves often emerge when multiple forces align at the same time. One catalyst alone may create temporary momentum. Several catalysts together can create structural momentum. That distinction matters enormously, because structural trends tend to persist longer than most people expect. Another factor investors often overlook is psychology. Markets are not driven solely by mathematics. They are driven by perception. When perception changes, valuation frameworks change. An asset ignored for years can suddenly become important. An asset considered boring can suddenly become strategic. An asset viewed as secondary can suddenly become essential. The shift begins quietly. A few investors pay attention. A few institutions adjust allocations. A few analysts change their outlook. Then awareness spreads, more capital enters, more discussion follows, momentum builds. Eventually, the broader public notices. By then, the narrative has already changed. This sequence has appeared repeatedly throughout financial history. The crowd typically arrives after the trend becomes visible. The early participants arrive when the trend is still developing. That is why understanding macroeconomic transitions matters so much. The goal is not predicting exact dates. The goal is recognizing changing conditions before they become obvious. And right now, several conditions are moving in a direction that deserves serious attention. Debt levels remain elevated. Curiosity concerns continue emerging around the world. Geopolitical tensions remain significant. Governments face growing fiscal obligations. Industrial modernization continues accelerating. Technology requires resources. Ditzgras requires resources. Energy systems require resources. All of those realities exist simultaneously. None of them guarantee a specific outcome, but together they create an environment where silver becomes increasingly difficult to ignore. The market may not react immediately. It rarely does. Major transitions often spend years developing beneath the surface, then suddenly the market begins pricing them in. What looked like a distant possibility becomes a present reality. And investors who spent years dismissing the trend begin scrambling to understand what changed. The truth is that nothing changed overnight. The underlying forces were already there. The market simply took time to recognize them. That is why experienced macro investors spend so much time studying structural developments. They understand that the biggest opportunities often emerge long before the headlines catch up. And in the case of silver, the combination of industrial demand, monetary relevance, constrained supply dynamics, and changing investor psychology may be creating conditions that deserve far more attention than they currently receive. Now, I want you to step back and look at the bigger picture again, because silver is not really the story. The story is the system. Silver is simply one potential consequence of what may be developing within that system. Too many investors focus exclusively on individual assets while ignoring the environment that ultimately drives those assets. That approach works during stable periods. It becomes dangerous during transitions. And what concerns many long-term macro observers today is not a single market event. It is the growing number of signals pointing toward a changing financial landscape. Think about what has happened over the last several decades. Global debt expanded dramatically. Financial markets became increasingly dependent on liquidity. Governments accumulated larger obligations. Asset valuations benefited from declining interest rates and abundant credit. For a long time, those trends reinforced one another. Growth supported confidence. Confidence supported borrowing, supported spending. Spending supported growth. The cycle appeared self-sustaining, but every cycle eventually encounters limits. Not necessarily because policymakers fail, not necessarily because investors make mistakes, but because mathematics eventually becomes impossible to ignore. Debt can grow for long periods. Yet debt cannot permanently outpace productive capacity without consequences. At some point, the burden becomes large enough that policy choices narrow. This is where many advanced economies find themselves today. They are attempting to support growth while managing substantial debt obligations. They are attempting to control inflation without destabilizing financial markets. They are attempting to maintain confidence while navigating geopolitical uncertainty. Those objectives are not always compatible. Laxters that solve one problem often create another. Raise interest rates aggressively and economic activity may weaken. Keep rates too low and inflationary pressures may persist. Reduce spending and growth may slow. Increase spending and deficits may expand. There are no perfect solutions. Only trade-offs. That reality is important because investors often assume policymakers possess unlimited flexibility. History suggests otherwise. Eventually, economic constraints become more powerful than political preferences. When that happens, markets begin repricing expectations, and repricing events can be extremely significant. They often start with small changes, a shift in inflation expectations, a shift in bond market behavior, a shift in capital allocation preferences. Most people barely notice. Then the changes accumulate. Confidence gradually adjusts. Capital begins moving toward different areas of the market. Investment priorities evolve. The definition of safety changes. That last point deserves special attention because safety is not a fixed concept. What appears safe during one economic regime may not appear safe during another. During periods of stable purchasing power, cash can feel safe. During periods of declining purchasing power, cash may become less attractive. During periods of strong real yields, bonds can appear highly defensive. During periods of negative real yields, investors often reconsider their assumptions. This is why macro transitions matter. They alter incentives, they change behavior, they redirect capital, and capital flows are ultimately what move markets. The most important moves in financial history were rarely caused by a single headline. They were caused by changing perceptions. People began viewing the future differently. That change influenced decisions. Those decisions influence capital flows. Capital flows influence prices. Prices influence psychology. And the cycle reinforced itself. If a similar process develops during the years ahead, tangible assets could attract increasing attention, not because investors suddenly become fearful, but because they become pragmatic. They begin asking a different question. Instead of asking how much nominal return an asset can generate, they ask how effectively that asset can preserve real purchasing power. That distinction changes everything. Because preserving wealth and growing wealth are related objectives, but they are not identical objectives. During stable periods, investors often prioritize growth. During uncertain periods, preservation becomes more important. This is where silver continues entering the conversation, not as a guaranteed outcome, not as a magical solution, but as an asset whose characteristics may align with emerging macro conditions. Its scarcity matters, its industrial relevance matters, its monetary history matters, its accessibility matters, and perhaps most importantly, its position between the industrial economy and the monetary system matters. That unique combination is difficult to replicate. If industrial demand continues expanding while monetary concerns continue growing, silver could find itself benefiting from multiple sources of interest simultaneously. That possibility is what attracts attention from experienced macro investors. They are not necessarily focused on next week. They are not necessarily focused on next month. They are focused on direction. They are focused on pressure. They are focused on long-term forces that gradually reshape markets. And when they study today's environment, they see conditions that deserve careful observation: rising debt, pessid fiscal challenges, technological transformation, infrastructure investment, monetary uncertainty, changing geopolitical relationships. None of these developments exist in isolation. They interact, they reinforce one another, they influence policy decisions, they influence investor behavior, and ultimately they influence asset prices. The real question is not whether change will occur. Change is always occurring. The real question is whether investors recognize the significance of that change before the majority does. Because by the time everyone agrees on a trend, much of the opportunity is often gone. History has demonstrated this repeatedly. The largest financial shifts rarely feel obvious at the beginning. They feel uncertain, they feel controversial, they feel premature. Only later do they appear inevitable. That is why paying attention to structural developments is so important. Not because anyone can predict the exact path ahead, not because anyone knows the precise timing, but because understanding the direction of pressure provides a significant advantage. And right now, many of those pressures continue pointing toward a world where tangible assets may play a larger role than they have in recent years. Whether silver ultimately reaches extraordinary levels is less important than understanding why serious investors continue discussing it. The discussion is not really about a price target. It is about a changing financial environment. It is about debt cycles. It is about monetary credibility. It is about purchasing power. It is about recognizing patterns that have appeared repeatedly throughout history. And if those patterns continue unfolding, the move many investors consider distant today could arrive much sooner than they currently believe.